Last week, one of you asked me about settlement risk, which I told is part of credit risk, mainly dealing with the LCs and those settlements. Yes, a small addition to that, settlement risk is a part of credit risk, and we say it is a non-financial risk. Whether there will be a delay in settlement or the uncertainty someone will settle us. That is the settlement risk. Like whenever you are doing a LC or a derivative selling or even bond selling, right? We come across this settlement risk. We say we have company A who has sold the bonds and company B from where we have purchased the bonds, right? It can be a broker, right? If the original party does not pay, then it is the financial loss or the credit. Original party repay, but the second party does not settle the bank, then it is the settlement risk. So what I want to say is settlement risk is a part of credit risk, but it is to deal with settling a agreed contract, right? That's a small addition to what I told you last time. So we call this settlement risk at hazard risk as well. Hazard risk, why this hazard name came, 1970, it is a bank in Germany. 1974, this bank collapsed. Like they were doing a larger deal in US and they collected the money, but they didn't pay to the US counterparty. So German government had to close down this bank. With this unsettlement, only the Basel started, right? Because of this hazard bank collapse, that time financial issues started. With that, all the things relating to Basel started from there. So G10 country central banks get together in Bank for International Settlement Switzerland, which is located at Basel. Then this Basel matter came up with this hazard bank collapse. So this settlement risk is called hazard risk as well, right? Okay. With that, any other question from last week?
Sir, can you include bank guarantee and bid bonds also into that category?
Bank guarantee and bid bond. Yes, if we don't settle, that will be there. Because settlement risk is something to do with non-settlement of agreed contract. Okay.
Okay.
Right. Any other questions from last week? Right. If no questions, I will go to today's lecture. Right. So today we will discuss about credit admin function on the credit chain, right? Role of the credit administration and challenges and opportunities, type of functions of a credit admin unit. Because the credit process can be structured in different ways. It can be centrally, it can be decentrally, there can be credit selling, like that. Different people, different departments will come into play in the credit process. Credit admin, if you can remember last time, I drew the graph. There you have a portion called credit admin. The main problem here is banks and the general trend is to undermine the importance of credit administration unit in the pretext of activities involved with that. Because credit admin unit, whatever the functions they will perform are routine jobs. Whereas the credit officer and the credit selling part, we are given targets and we need to achieve those targets. Whereas credit admin, the main purpose of credit admin is to book proper credit into the system. So this will cover setting up limits, risk function, CRD function, everything will cover under this one. So these are things, say back office. So these are routine, right? This is the different departments and different people who will get involved in doing credit. We have credit marketing, lending division, credit divisions, trade admin department, credit risk department. Like that, we have so many departments and different people, titles coming up on the credit process, right? You saw this one last week as well. This is the credit process where you have the initiation with the branch level. It can be branch level, it can be sales team level. Then you do the pre-evaluation, negotiation, approval. That is the credit line. From there onward, credit admin function starts in documentation, document signing, then covenant conditions, payments, compliance monitoring, settlements. Everything comes under credit admin. Right? This is what I just told. Relationship manager's job is to put more loans to the table. We credit people or the front end is evaluated based on the number of loans or portfolio growth, all those things. But whereas credit admin or the routine, the backend function is to quality of loans and the booked under quality of the book. So quality of the loan and maintenance of our portfolio's quality is the main function of credit admin. Normally, frontline, the business lines get frustrated. We bring loans, but it is very hard sometimes to, we think it is very good. Actually speaking, for the last 2.5, maybe 2 months time, I am fighting with the people to grant a loan. I think we should give, but risk things, no, we should not give, right? So we are fighting to come into a conclusion there, right? So then we get frustrated because we think and we are bringing a good loan and this is needed to be given, and then the other party comes and say, no, don't do it, this risk, right? Reason is we look at only a one angle. We want to book a loan, we want to service the customer, we want to increase the portfolio. But the back end, they will know the exposures to different segments, the areas positions of different segments, all those things, they will know the bigger picture. So as a credit person, always we need to understand the risk perspective also than just fighting. But when it is to the front end, what we always think, whatever we bring, it should be booked and we should be allowed to book, right? How many of us, we have 40 people here, how many of us have read the credit manual properly? Yes, everyone, whoever done credit, they have gone through the credit manual one way or other. But how many of us can remember the credit manual, credit policy document properly? Right? So learning why such policies and procedures have developed for underwriting and why certain rules exist which actually exist are in booking high quality credit. All this because the main risk associated with banking. It can be retail banking, it can be corporate banking, SME banking. It is the credit risk, right? As I told, and everyone of you know, our function is twofold: deposit mobilization and lending, right? Whatever we bring as deposits, we have to lend. Otherwise, we are not going to earn money, right? So once you lend, if you do a wrong lending, recovery would be a problem. When recovery is a problem, we can't pay to the deposit holders. Then credit risk arises on the depositor side as well as bank side. Right? In order to avoid that, all these functions has come in. That's why we need to have a proper credit administration process to manage the credit risk. This is the regulator's view. Who like it is a, I showed you 3 I's policy, which is the business line, internal audit, risk, and the internal audit, right? Similarly, what the regulator, CBSL, even the BCBS, banking, Basel Committee on Banking Supervision, both says the same thing. One unit should bring the business. Business canvassing, evaluation can be done by one unit. But there has to be another eye which independently looks at the credit before approval. Then once it is approved, system booking, like whoever is approving should not be involved in disbursement. So this is segregation of duties, right? We can say earlier, few years ago, maybe 10 years, 15 years ago, whatever, like we had very centralized, decentralized models among all of our banks, right? I can remember when I was a manager in NDB Development Bank, I had an accountant, then I had the lawyer, I had the credit people in-house. So we used to canvass, we used to evaluate, we used to approve, then legal officer do the legal documentation, we disperse. So everything within the branch, we were fully equipped, right? So if I bought a bogus loan, all others are my team, though they have different reporting lines. Credit officers are reporting to me, legal officers though reporting to me, they were reporting to the head of legal as well. Then accountant, he was reporting to me, but he had a dual control reporting to accounting department as well, right? So it is a single team. So you bring a bogus loan, you approve it, you disperse it, recovery also you manage somehow, right? So this is not good. So BCBS came and said, don't do this kind of thing. Whoever brings should not be approving, or whoever like the sales function and credit evaluation approval function and the loan disbursement and system function has to be 3 different units, right? So main front line will report to the business head, whereas the risk line will report to board integrated risk management committee, risk head or chief risk officer. Then the credit admin or the operational unit will report to the chief operating officer of a bank or person who is heading the operations of the bank. So this is the view of CBSL now. No single person should be allowed to complete a transaction. You look at the treasury. You have treasury front office, treasury mid office, and treasury back office. Dealer does a deal, then mid office will perform the required function, then back office will do the maintenance and recording function. So it is segregated. So credit admin comes in this. Whoever brings should not be involved in the operation or admin part of the credit, right? So again, BCBS, bank should have in place system for the ongoing administration of their various credit risk bearing portfolios. What does this mean? Right? Our portfolio needs to be risk rated. What is the risk rating? Risk rating is the credit worthiness of a customer. So each and every customer of a bank, borrowing customer, needs to be risk rated, right? That means from the credit card to a personal loan to a business loan to a project finance loan, customers need to be risk rated. Then we will know what is the credit worthiness of each customer. So we say credit rating starts with AAA. That is the best rate we can have. AAA to D, default, this is the rating spectrum. Double B and above is called the investment grade, and B and below will be speculative grade. This is the international standard. Many banks follow the same standard. Some banks use different names but in line with this standard. Right? So when you have the portfolio risk rated, you know, okay, I have out of 100 billion portfolio, I have 1 billion in AAA. I have another 10 billion in AA plus. So whatever you do with a AAA is different from AA. As example, I'll take it from a branch, right? You have a single A customers. There you need to do monthly visits, monthly calls, monthly reports. Whereas better ones, AA, you don't need a monthly, you need a quarterly one. Or visit, or you need to get the documents quarterly, reviews annually, like that. AAA, you don't need to do anything, they anyway pay, and you do an annual review only. So different portfolios, risk-bearing portfolios, need to be managed differently. Therefore, we should have a proper system to administer this. So that is the regulatory view from BCBS. Bank should have in place a system for the ongoing administration of their various credit risk-bearing portfolios. Credit admin is a critical element in maintaining safety and soundness of a bank. We can book, but maintain, like even a good loan booked and you don't look after that loan, it can go wrong. But maintaining a loan is not only a responsibility of credit admin, right? It is like business line and credit admin teams both together should maintain a loan, because business line is the front end of a bank. So they deal with the customer. So visits and knowing the customer is the key function of business line. So always you need to have a discussion between credit admin and the business line. They are jointly last rupee collected from the customer, everything should be managed. Files should be updated properly. Like sometimes we have granted the facility, after nothing. insurance policies, we don't know where it is. We need to maintain. Like, it's better to have good to have an insurance policy, but if it is not renewed, no point having that. Then stock statements, debtor statements, reviews, all those things we need to maintain. So this includes keeping the credit file up to date, updating current financial information. Like, we grant a facility, we don't review that. So we don't know the financial situation. Customer is paying does not mean that business is operating well. We don't know until, like, we ignore all the early warning signals, suddenly a NPL hit. Like, customers can pay from various means, but we need to know how the business is operating. Because if the business is crashing, we should go out of that business. We should come out of that customer. So when it is long term, it is difficult, but you should know we don't want any sudden hits or sudden shocks in NPL. Then when it comes to the credit admin function, different banks does it separately. Like, we can say, even today, we have banks who are operating on a branch model, or who are operating on decentralized model. There you have the branch manager who has a delegation, who is responsible for everything. But you have another assistant manager who has a responsibility dotted line to the operation. So there is a way of controlling, right? But even on a centralized model where all this great admin function happens centrally, when the bank is small, same person will have to do few functions together. But when it is larger, the bank is larger, functions will be spread around larger number of people. Like, we take an example, the person who is responsible for limit loading to the system may be the same person who is doing the disbursement, right? But maybe reporting to two managers, because two different functions, right? One function manager should not be reported. But when it is a large organization, larger centralized and formalized model, limit loading will happen by one team, and document checking will happen by one team, limit loading one team, disbursement one team. So each line will have different function and authorities. So last para, when individuals perform such sensitive functions are custody of key documents, writing out funds, they should report to managers who are independent of the business origination and credit approval process. Then we will come. Today lecture is very theoretical lecture, but this is the function we have been pushing now. From decentralized model, Basel wants all the banks to go into centralized model. That's how this credit admin function's importance comes up, right? So when we are developing our credit administration, we need to look at 5 areas, right? Efficiency and effectiveness of credit administration, because it has to do the documentation, monitoring, legal covenant monitoring, collateral monitoring, stock monitoring, everything. So it has to be efficient and effective, right? Then accuracy and timeliness of information, because they are the brain, they are the heart of the credit function, right? So all information lies with them. If they don't have proper way of giving information, it has to be timely, it has to be accurate. Like, I want to know what is our exposure to Russia. If it takes 3 weeks to find our exposure, then by that time my entire business may have collapsed, right? So because of that, accuracy and timeliness of information is very, very important. Like, I just want to know what is my exposure to DA documents, DP documents, right? If I can't get those information fast, I will have an issue. Give 1 minute. If I can't get the information fast, or if I can't get information correctly, accurately, I have a problem of maintaining my business line and the risk I have. Therefore, MIS is a key function when we are developing a credit administration function. Segregation of duties. As I told, you should not allow the same person to do, like limit loading and disbursement, we should not do by the same person. But if we have to do it because of our size, he should report to 2 different managers for the authorization, right? Segregation of duties. Then adequacy of control over back office procedures. We need to have proper controls, dual authorizations, like that, different controls we need to have. Dual authorization, internal checking, internal audit function properly, everything should be there on the back office function. Then compliance with prescribed risk management policies and applicable laws and regulations. So when developing this, we need to adhere and comply to all the risk guidelines given, right? It can be operation risk, it can be credit risk, transaction risk, all those things we have to adhere to, including the regulations and laws of the country. So these are the 5 items we should look at when developing a credit administration function: efficiency, accuracy, segregation of duties, adequacy of control over back office function, and compliance. So you have to remember that. For the various components of credit admin function to appropriate senior management, that means, like, okay, we can have the structures to get and everything, but if the senior management does not believe and support, right, we can't run this kind of a operation. They should recognize the importance of credit admin, and then only we can do the proper segregated approval admin function. Senior management must understand and demonstrate that it recognizes the importance of this element, right? So sometimes senior management thinks business line is the key. Yes, it is the key, but maintenance of the credit also very, very important. You bring everything, book, but you don't maintain, you will have a issue, right? Before going there, any questions you have? Do you have any questions? I'm taking you through the credit admin function and how the BCBS thinks that on that, and even the CBSL think on a credit admin function. How to develop a credit admin function within the bank. Right. Then we will go to, if no questions, we will go to typical functions of a credit administration unit. These are some of the functions, main functions credit administration will look at. Establishing and granting of limits, executing, checking, maintaining security documents, maintenance of insurance registry, maintenance collateral valuation, periodic changes in interest rate, pledge operation, ensure compliance and monitoring of covenants, regulatory management reporting, and recovery of charges. These are some functions. Right? There can be other functions, but these are the main functions we have to cover under credit admin. Right? Establishing and granting of limits, like release loan process, that is disbursements. Then stage-wise disbursement, like if we want to disburse on several stages with the project progress. So credit admin is the one who is doing it, that is the control. Right? We have taken that control from the branch or the front line and given to a credit admin. So they will look at, they will maintain the disbursement schedule. They will look at, okay, he has come for disbursement. What is there in the offer letter? You need to have a visit report. You need to have supporting document. Then based on those supporting evidence, they will do the disbursement. Otherwise, just we want to do a disbursement, they will not. So that makes the bank secure. Otherwise, money we grant, we give the money and that money can go to the customer even without fulfilling the intended function. Like we gave the loan for construction of a warehouse. Right? So disbursement will be gradual. Otherwise, you give all the money. Sometimes they don't construct the warehouse, they go and construct a house in use of money. So in order to avoid that kind of scenario, credit admin is responsible for gradual disbursement. Right? So, and again, we do approval, appraisal, then we do a offer letter. Appraisal and the offer letter should match. That's not enough. Offer letter and the system should be matched. Right? Accurate offer letter has to be inputted to the system. I can remember once, right? We gave a loan to be repaid in 5 years or 4 years. Then whoever they inputted and authorized, they did a mistake. For 2 good years, customer was not paying capital. 1 year grace, they have given it as 2-year grace. Right? Suddenly, when the repayment starts, only we also realize this is what has happened. Right? Make accurate structure of credit in the system is very, very important. We all are human. There can be human errors at any time. That is the operational risk. Right? So we had to reschedule the facility and give the customer more time because it was our own mistake. We couldn't ask the customer to pay the additional amount. Right? So that is a risk and it is a loss to the bank. Granting of revolving loans. Like whenever we grant short-term loans, revolving type. Right? trade loans, import loans, all these comes under credit admin. Yes, trade, it is within the trade, but it is credit admin function. Execution and checking and maintenance of security documentation. Like we do so some banks still offer letters are being prepared at the front line. So what we discuss here is what the BCBS wants, Basel Committee Banking Supervision wants, and what our central bank intended every one of us to do, right? So don't get mixed and say that, okay, we are not doing it like that. This is what the BCBS wants, right? So preparation and execution, maintenance of security documentation. Once the facility is approved, the approval party or the business line should not do the offer letter. It should be done by the third party, which is the credit admin unit. So we give the appraisal report. Based on this appraisal report, credit admin should prepare the offer letter and give it back to us for signing, right? So whenever there is some clauses, whenever business line want to put some clauses, or whenever regular clauses are not there, CAU, Credit Admin Unit, should deal with the business line and the legal to get the clauses perfected. That means terms and conditions. Normally, immovable property, that is land and building, mortgage registration will have to happen through the legal officer. Why? They are giving their own number for that, right? Mortgage bond number. But all other mortgages, RMB, company register, like you can say, oh, currently our legal officer is doing the company raise. But as per the theory, except for the mortgage bond registration, all other outside registration has to be done by this CAU. Release and replacement of collateral. Like safe custody is a function of CAU. That means once the offer is signed, mortgage executed, all the original documents should be kept in one place, safe. So sometimes some banks we keep it with the branch, but normally it should be the center who is maintaining everything, and this is the safe pack they will maintain. So whenever there is a release or addition, they will have to do. Nothing to do with business line. So all the back-end function should be taken out from the business line. Recovery of charges and fees. System-related things has to be done by a third party. We should not get involved. Business line should not get, whenever I say we, it is the business line. Then the insurance registry. One of the key functions of a credit officer is to get the mortgage property insured properly. Why we have an insurance? Insurance is the fourth way of taking risk, transferring of risk, right? We have taken a mortgage, we have forgot to take the fire insurance, or we have not renewed the fire insurance. Then what will happen? Suddenly something goes wrong and an asset caught fire. Then damage will be twofold. Customer will not have money to repay the bank, and customer will not have money to rebuild the business as well, right? So if we had insured, we can cover bank side first, right? Because when something like that, we are not going to give more money for the customer to come out. Yes, we give sometimes, but with regular thinking, we hardly give that kind of money. So maintenance of insurance diary is very, very important function. Right? You have to renew, like, okay, you need to have the insurance, then you need to have the original policy. You need to check whether our mortgage asset is insured properly, all the perils are there, all those things are. Then suddenly, nowadays we see, we get the insurance policy, but the customers have not paid. Then when we go for claim, they say, no, this has been lapsed. Right? So we have to make sure whether the customer has paid before issuing the original policy to the bank. Then original policy should be there. Then that policy should be assigned to the bank as well. Otherwise, you can't claim money. Money will go to the customer. So always, assigned party should be the bank. Assignee should be the bank. Right? Policy should be assigned. So then we need to monitor the renewals. We have to monitor. If it is business line alone does that, it is overburdening the business line. So independent party is checking the insurance policies, renewals, and business line will have to collect it and give it to them. Sometimes they can directly contact the customer, as the business lines always should support the credit admin function. So renewable monitoring. So firstly, original policy maintenance, peril checking, then renewal monitoring has to be done by the CAU function. Then for the risk department, they should give us information like, okay, insurance policy wise, what is the exposure bank will have? Because one insurance policy go bankrupt, we all get hit. Right? There can be anything. So risk parameters has to be there, and CAU should maintain those things. Whenever there is a claim requirement, we have to lodge the claim. Then sometimes we will have to give no objection letter. All those things need to be done by a separate unit. So when we have what do you call leasing department does the same thing, but it is the leasing admin function which is separate from the business function. Right? So the perfect way is to have separate department to do everything. Sometimes due to structures and all that, different departments will have this function separately, but these people will have links to the other heads as well, not to the business line head. Right? Again, it is a compulsory thing. If the customer does not pay the insurance premium, bank needs to pay the insurance premium, and when the bank pays, it is a part and parcel of the loan. Customer unconditionally binds to pay the insurance premium of a bank, right? When it hits his account. Then maintenance of collateral and collateral valuation. We need to maintain our valuer panel, right? Sometimes valuers are giving exorbitant values. Then we have to take them out. So this admin function, credit admin function, it is not only limit setting, it is not only offer letter preparation, it is everything. Credit admin related, administration related. So like immovable property valuers, then if there is any errors, blacklisting valuers. all those things, policy reported things, also done under credit admin. It may be done by a risk department, but it is a function of credit admin. So we need to obtain valuations, renew the valuations, right? In order to do that, we have to maintain valuation, collateral information, right? Every 3 years and 4 years, we need to do valuations. So in order to do that, we need to know what are the due for valuations. So those functions CAU has to do. Then update equity share prices, margin factor, that is a part of Treasury Mid Office. Monitor and update currency fluctuation, again the same thing. So it is not only lending to normal customers, even Treasury, that is a part of our lending. So back office, mid office and the front office of Treasury, it is again broken. So 1 and 2 here is Treasury functions. Then the fourth one, carry out stock inspection. So we put covenant saying that stock maintenance, stock mortgages. Whenever we take stock mortgages, we need to see the stocks. It is good to have stock statements, but if we don't go and visit those things, it is no point having it. Stock statement monitoring, then visiting stocks, everything need to be done by. Then we will have a problem. How can centralized model operate all over the country? See, I'm not talking about 5 million facility or 10 million facility. In that kind of a smaller facility, yes, CAU central function can tell the branch, go and visit and give a report. These are due for stock inspection. Then the branch should comply to it, right? But in larger facilities, independently, a billion facility or 500 million facility, independent party should do the evaluation, because business lines can have customer pressure, right? Because we are very familiar with the customer, right? I'll give you an example. Long time ago, we had a pledge facility, right? Vehicle pledge. Then we had needed to go and do the stock inspection. Our manager and the credit officer went. They were shown the vehicles. Yes, there were vehicles. They just checked and came. Number of vehicles were correct. We said 25 CR books, and there were 25 vehicles of the same origin. Right? We just checked and came. 10 Premios, 10 BMWs, like that. We checked and came. Right? Then within a week, the entire stock disappeared. Right? Because they were very familiar with the customer, they showed the cars, they noted it down and came. They go into details of checking the chassis numbers, engine numbers, those things. Right? So they were caught into a racket, and even they were temporarily suspended from work. So when a third party goes, they are not familiar with the customer. That is their job, just to check everything properly. So carrying out stock inspection is a key. Currently, even in our bank, large stock inspections are being done by this third party, right? Not the business line. But smaller stock inspections, we centrally monitor and we inform to the relevant business line, and they have to do the inspection and centrally mark that. Collateral valuation is a very important thing, because as per the central bank also, we need to have a current collateral valuation, otherwise we can't take it for impairment provisioning. Therefore, we need to know the proper collateral values up to date. Then interest rate changes, right? Changes to the base rate, AWPLR, LIBOR, AWDLR plus rates. Whenever there is a change, we need to update the system. That has to be done centrally and independently. Adjust the margins. Whenever we want, like last week, no, prior to that, we saw the policy rate hike. Then we have to adjust our rates. So margin changes has to be done by them. These days we don't have penal rate. Whenever there is a penal rate adjusted by this independent party. Monitoring of covenants. What are covenants? We discussed. These are the terms or conditions we put to a customer to maintain the same risk level during the tenure of the facility. Covenants can be affirmative or positive covenants and negative or restrictive covenants. Right? So it is good to put all sort of covenants. But if we don't monitor those covenants, no point putting these covenants. So there has to be someone who needs to monitor. Like earlier we used to monitor this through manual process. So we have to have Excel files. Initially it was on a book. Then we went to Excel. Now we don't do it manually. We have a robot who monitors covenants for us. So it is under the CAU function. Robo works 24/7. It is working. So every day we get a email saying this customer, this covenant has not been fulfilled. Then we have to take action. When the business line alone is doing it, we know the customer, we call. If it is not happening, we are not doing anything. So covenant monitoring is a very, very important thing. Without monitoring the covenant, no point putting the covenants, because covenants were given to maintain the risk profile. Right? Progress report of compliance to covenant should be submitted to credit admin. So whenever there is a lapse in covenant, we have to update it and send back to CAU. Because, see, we will take a small covenant. You need to send 5 million rupees annual monthly turnover to the current account. Customer breaches, right? So we forget about it. Then these operations will not come to our bank. We don't know anything because we can't individually monitor everything. We don't know anything about this customer. Right? Check return, it's a covenant. So again, submission of annual accounts or monthly stock statement. Covenant is there. If you don't monitor, you can't remember everything. You will not get those things done. Right? So you need to monitor those things. Regulatory and management reporting. I told you about MIS, submission of whatever CBSL requirements, crib submission, everything has to happen centrally. Then new loans granted, board reporting we have, those things need to be done centrally. New loan granted, concentration data, because credit risk, concentration is the part of credit risk, right? Concentration data, documentation lapses, that is another key function CAU does. Because due to urgency, sometimes pending documents, we do some work, right? One signature missing, one initial missing, but still we go ahead. So then we need to follow it up and take. When everything goes good, everything good, smooth and good. But at the time of default, any lapses, any missing document will make our life very, very difficult. Provide credit portfolio data, capital calculation, finance department, right? What is happening there? We need to calculate capital requirement for capital adequacy ratio. For that, you need to have the portfolio data, risk rating wise, right? Feed information to bank risk department, single borrower limits, sectorial limits, all those things. Basically, MIS function has to happen from CAU because they are the centerpiece and they are the heart of the operation. And again, passing entries in the system, reconciliation, pledge, operation, loan recovery, full settlement, all those things should be done by CAU. Business line should not be allowed to pass entries to the system. Right? It has to be done by an independent body. We can only view the system, not authorize and input to the system. So that covers the CAU function, right? This is the exact way BCBS wants us to operate because they are advocating pure centralized model, right? They don't want decentralized front end to take decisions and go in, right? They are advocating a pure centralized model. So in that process, CAU plays a very, very vital role. This role, what I discussed today is that role. Different functions are there. These are the functions. Then these are the areas we have to look at when developing a CAU function. Any questions from this part before I go to the other part?
Sir, excuse me.
Yeah.
This is Dushandani speaking.
Yeah.
What is the difference between the mortgage cover and title insurance? Are they any similar? Both insurance are connected or is different?
Right. It is two different. Just hold on. Manjula, I will answer you. Give me 1 minute. I will finish this question. Then I will answer you. Title insurance is something to do with the title of the property.
Okay, absolutely correct. Yes.
Right? So basically, what they say, if there is an issue with the title, you have to file a case, right?
Yeah.
And they will bear the cost of that case.
Yes. Yes.
But I don't know, never ever they have paid a title insurance.
Even though title cover is there, they are not paying the insurance.
Yeah.
Am I correct?
I have never come across the case where insurance company has the bank. Right? What they say, there may be instances, but I have never, for my 24 years of credit experience, I have never come across. Right? But for the comfort of the title, we take that. Right? And because once I had a detailed argument with the insurance company, then what they said is the title insurance is not a recovery mechanism. right? You go put a case. If you whatever you incur, we will pay you. That kind of a thing, right? That is
Yeah.
the title insurance.
Yes.
That is related to title.
Yes.
Mortgage insurance is
Yeah.
can be termed as mortgage insurance. It can be termed as mortgage protection policy, portfolio policy. That is, if the customer dies, insurance company will pay the mortgage value.
So then what about loan protection cover also same? No, if the customer is die, then loan protection cover also same, no?
Yeah, it's the same.
So then ultimately,
Yeah.
no need to go for a title insurance. If we go for a mortgage insurance, that is in bank point of view is
It is two different things. Client has to die.
uh,
Mortgage protection,
yeah,
client has to die.
yeah. But if the but as per your experience,
Yeah.
even though if the title insurance is there, if something is wrong, insurance company will not pay. Am I correct?
I have never come across an instance where the insurance company paid. Right? For our comfort, we are taking title insurance.
Just for a documentary purpose. That's all.
Just for documentary requirement. Practically, I have not come across that kind of a thing.
Right.
Right? But we take it for the comfort of the legal officers. We take the title saying that if something goes wrong, we go for legal action on the title, and that cost relating to that, this insurance company will pay. That is the one side.
I got. Anyway, then if the mortgage cover is there, no need the loan protection cover, right? Loan protection cover.
Loan protection, mortgage cover, all are the same.
Same, yes. That's what I'm telling. Either of the cover is enough.
But title insurance cover and mortgage protection covers are two different.
Yes. I got it. What I'm telling, as per the latest information,
Yeah.
mortgage cover and loan protection cover both are almost same.
Yes. Yeah.
Right?
Yeah.
Am I correct?
Yes. It is almost the same.
Right. Okay, sir. Thanks. Doubt is clear.
Right. Okay. As per BCBS, this risk comes under CAU. CAU, credit admin. Risk part also, like risk, we have different things. We have operation risk, we have credit review risk, like that, different risk. So part of it comes under CAU function. It is a CAU function. Credit CAU, like in our banks, we have credit admin unit, right? But credit admin function is a broader thing. So CRD, credit review, comes under CAU function, right? Even risk part where who looks at the valuers, it comes under CAU function, right? It is a gray area, but some part of risk comes under CAU, not the entire risk. Manjula, is it okay? Clear?
So I also have a question with regard to insurance. That
Yes.
This is not the title insurance or the MRP or whatever insurance. This is with regard to fire policies. Sometimes we come across the situations like the properties which we are mortgage are not having not having approved building plans or the COCs. So when those are not there, valuers are not giving the building values. So we take only the land value.
Yeah.
So what we do is we waive off the insurance policies of the insurance covers of the buildings. So what is the best opinion you can give for that? If the business is running on that particular building,
Yeah.
what is the risk we are having?
It is risk is like this, right? Business is there. I'll give you my live example. I had a customer, right, who had mortgaged land for us, and he was running a business in a separate plot of land and near his house, right? I had been telling this customer, do a insurance. because in Sri Lanka we don't believe in insurance, right? So do a insurance. He never agreed because I have given you a security. Why should I insure? This is my problem. I am not. Your loan is covered. One day there was a fire, and his house and the business both got affected. All burned up. Right? So now what happened? He is without anything, no place to live and no business. He has to rebuild everything. I'm not going to give him money as well because he does not have a way of repaying. Then I wanted to go and take the land which is mortgaged to us. Then I couldn't do that as well. Why? When I go to post to do that, just took the customer side. And so we had to wait a long time before we do anything. So if we had the insurance, they could have get that money, settle us. Because whenever we take a insurance, it will come to us. Right? We are the assignee. Right? So at least the bank can go out and the property can be given to the customer to rebuild. Right? Api insurance ek ganan ganna wadan naha kiya. But when the calamity happens, only we have the requirement. So your case also, this is a very common thing, and we are fighting day in and day out not to do this. Right? There is a value land, highly valued. So why should I insure my property? You have enough cover from the land alone. But when something goes wrong, who is going to bear the cost? Is it clear?
Yes. Thank you, sir.
Even you don't have a COC, if you can get an insurance policy, take it. And other thing is, you need to take the insurance policy for the valuation, not for the facility size. Otherwise, what will happen, when there is a claim, they will deduct underinsured. Right? Any other questions? Right? We will discuss pricing. Right? Whenever we do pricing, we look at customer characteristics, right? Like credit scoring. We don't offer the same price to everyone, do we? No, we don't. Across board, everyone 2%, 3% margin? No. Based on the characteristics, different factors, we offer different pricing. And customer characteristics is a key in deciding the pricing of a product. Credit scoring. So based on the risk rating, we may fluctuate the pricing. AAA, we may be 0.5% of transfer if we are basic on transfer pricing. Like John Keys normally comes and tells, I want AWPLR minus. So they are AAA. Right? So we link our margin to price rating. Then the geographical area. If the number of if the customer is away from the bank or number of competition is low, based on the geography, we price the customer. Because when it is very competitive, we can't have higher price. But in a rural area where we don't have much competition, we can price. If the customer is far away and we need to go and visit, it takes a lot of cost, we can price based on that. Relationship. New customers normally get higher price. Existing, good repayment, will get a lower price. Like that, customer characteristics are important in deciding the pricing. Then we have channels, right? Why? What are those? Branches, right? All sales team, like whoever comes to a branch and take a loan, can be priced one way. If a salesperson brings a loan, we can price it differently because two things. One is we need to pay the salesperson. Then second thing, customer get benefits by easiness of doing documentation. Then customer, our staff goes there, get it done everything from his doorstep. So there is a convenient factor. So there can be a price thing. Appointed brokers, like we hardly have those appointed brokers in the country, but in general we have mortgage brokers in other part of the world. Then digital channel. If the customers can be okay, I'm not coming to a bank, I'm not coming to a branch, I'm not using your brick and mortar branches, I am a digital customer. Then we, since they are not utilizing that, we can use the digital pricing. That means our overhead allocation for this kind of customers, it is low. So pricing can be lower in digital channels. But if the digital customer comes to a branch, you will be charged more. As an example, like we say, you go and take money from ATM, I'm not charging. Oh, I'm charging only 5 rupees. You come to the counter to withdraw money, I charge 20 rupees. So there can be a push towards the digital channel. So based on the channel, we can price differently. Then we have risk-based pricing approach. I will go into details what is this risk-based pricing approach. Then acquisition versus retention pricing. Sometimes what happens, though I said relationship pricing, new versus existing, sometimes what happens is we give very low price to acquire a customer. I want to take over a customer, so I offer a price which is lower than the market or our minimum lending rate. This is to get the customer on board. Once we lock the customer in, we may be charging high. Or you can have retention pricing. That means the customer wants to go out of the bank, so you try and give a good pricing. So retention versus acquisition. Risk basis, based on the risk parameters, we will charge. Right? What is let me finish it here. I'll go to the other one later. Okay, I have a question. Chamatka. Can there be situation where the insurance value stated by the valuer in the valuation report is higher than the building value he stated in the same report when arriving at? It can be. Insurance value is if we want to build a similar building, what will be the cost like? Right? We need to insure it. Building value can. I have seen that kind of cases as for example. Right? So you can have different values, insurance value and the building value. Can be. Right? I will take you through some pricing strategies. Okay, I will take you through some pricing strategies. I gave you this Word document. These are general pricing strategies, right? But it is very much applicable to the banks as well. So whenever we talk about pricing, we can think about these strategies as well. So mainly we have few strategies: cost-based pricing. So there we have absorption pricing, break-even pricing, and cost-plus pricing. What do you mean by here? What we do, pricing is based on the cost. Absorption pricing, you may or may not place a profit margin, but you cover your variable cost and the fixed cost. If you lend purely based on the TP plus the overheads without putting a margin, it is absorption. May or may not. Break even, there is no profit margin. You just put the fixed and the direct cost only. Right? Cost plus pricing, yes, we have our cost, plus we have a minimum margin of 3%. Right? This is the strategy. Cost-based pricing. We are deciding the pricing based on the cost. Right? We are deciding the pricing based on the cost. Value pricing strategies, dynamic pricing. Right? These pricing strategies do not rely upon cost, but rather perception of customers of the value of the products. Right? Dynamic pricing, it is mainly on the digital channel. When you have larger requirements, continuous requirement, digitally we increase the prices. Supply demand theory here, right? Premium pricing, the practice of setting price higher than the market rate, right? Whenever you are going for premium something, even you think about a credit card, premium cards, you have a higher pricing because you want benefits, so you pay. Then you talk about green channels on personal loans, right? You want the loan within 2 days, okay, this is my pricing. Then price skimming, the practice of initially setting high price to reap the unusually high profit when product is initially introduced, right? Whenever we introduce a new product, which all the other competitors does not have, we should be able to charge high. It can be fee, it can be interest rate, right? Because we are giving you a comfort, we are fulfilling your need, but all other competitors does not have that. If you want to use, you use it at high price. When the competition is there, we will reduce and go with the market. So it is nothing to do with cost. It is the way we think, right? Then we have teaser pricing. Premium pricing, the practice of offering basic services for free and charging price for higher service level. Look at this. You have electronic banking platforms. What you do, you say, okay, viewing only free. But if you want anything else, you have to pay. Viewing free, all others you need to pay. So it is freemium. Then low pricing. Locking products like housing. You price it low. Customer comes and get the housing loan. property mortgage to us. Then you go and give the other loans because property is with us. Now we can't go and get a loan from other banks. Right? Offer housing loan at low cost, so customers will come, property mortgage, then offer a business loan little higher. Because otherwise he will have to go to another bank with a business loan, but property is in bank A. High-low pricing strategy. Loss leader pricing. Right? We put a practical special offerings. So we get the customers in. Right? All these may not be applicable to us, but many of these are applicable. These are normal. We give something free or at cost, so customer can come and use. Like we talk about cross-selling. Whoever has a savings account, we try to get a fixed deposit, we try to get the business loan, we try to get the education loan. Like that, we get everything. Right? When we go to strategic pricing, limit pricing, penetration pricing, and price leadership. Limit pricing, the practice of setting a unusual low long-term price that will deter potential competitors from entering the market. Limit pricing. Think of this way. I don't know you are from which banks, right? This is nothing to do with any bank, right? Think, if Bank of Ceylon want the smaller banks to go out of business on housing, they are capable of coming and putting a housing loan at 6%, 10 years fixed. Can the other banks enter? No way. Right? So after a year or so, major portion of housing market is with Bank of Ceylon or whoever does that. So competition has been killed. That kind of pricing we do. Right? Whenever you open a branch, what you do, you give at a lower rate. So we can boost our portfolio. Penetration pricing, the practice of setting price below the market rate in order to increase the market share. Like just I told you. Whenever you open a new branch, you give a high on this. This is relating to lending. What I'm going to tell you is relating to deposit. If the market is going at 8%, you give 9% to attract deposits to our bank. Similarly, if the market is offering 10% for loans, give at 9% for a shorter period of time. Right? Penetration pricing. Price leadership, when one company sets a price, point is adopted by the competitors. It is with us banks as well. When someone, a larger bank, comes and say, okay, this is my lending price 5 years, everyone will have to follow that. When they increase, what has happened now? Major banks has increased the deposit rate. So gradually everyone will have to fall behind them. Otherwise, we will drive out our deposit. I practice this one very frequently. Psychological pricing. Whenever I want to get a customer, it is, we call barter pricing as well. Barter වල කොහොමද තියෙන්නේ? 99 සත 99. Right? So when recently also I got a 200 million, I could have given him 9. I didn't give him 9. I gave him 8.9. It is not 9. It is lower than that. Right? So people get the satisfaction. It is something 8. not 9. Right? Actual figures are different. I just give example. But I got a loan by just showing this kind of pricing. Right? Transfer pricing is like here the say subsidiaries, like when we are taking money from our treasury, this is the price they will give us. Right? Transfer price. They will cover their cost and give it to us. The business line. Then business line needs to keep a margin for their purpose. So these are pricing strategies we can adapt. Right? So these are general pricing strategies, but banks also time to time adapt these strategies depending on the circumstances. Right? Okay. Any questions from these pricing strategies? If no, we will have a break. We'll meet at 3:15, 3:20 max, 3:15 if possible. And then we will do the other part. Okay. Digital teaching, time flies. Right? Okay. Any question? Yeah. Okay. You can remember this graph, which I showed you last week. How a bank is being financed. Right? How a bank is being financed. You have light blue term deposits, FDs. Then you have CASA. Then you have term loans borrowing from other banks and institutions by the bank. Then you have money market. Then you have capital owners funds. Right? This is how we finance a bank. Right? Then as per Basel, we have something called capital adequacy ratio, which is called Cook ratio. Why? It is named after Peter Cook, the first chairman of Basel Committee, who is the Chancellor of Bank of England. Right? We call it Cook ratio, we call it capital adequacy ratio. Capital adequacy, like this is the initial one, capital adequacy, Cook ratio, capital adequacy ratio was capital divided by risk-weighted assets. Capital divided by risk-weighted asset, which should be more than 8%. What does that mean? This graph was done for that. If you want to lend 100 rupees, 8% of that has to be your own funds. Balance 92, you can finance through any of these methods or combination of these methods. That is the meaning of capital adequacy, right? Anything above 8% from your own funds, balance you get it from these mechanisms, right? That is capital adequacy. Capital divided by risk-weighted assets. When you talk about assets, you have two types of assets. On balance sheet or direct assets, off balance sheets or contingent assets. What are on balance sheet assets or direct assets? Any assets are loans and facilities. Any asset which has a cash outflow from the bank, then it is a direct on balance sheet asset, like term loans, ODs, leasing, housing, credit card,
everything. Where once granted, customer can take out the money. So there is an effect to your bank's cash flow. That is a direct assets. Then indirect assets. Any asset, there is no cash flow effect to the bank. Bank takes only a responsibility, then it is a indirect asset. Indirect assets are LCs, bank guarantees, derivatives, all those things, right? Indirect assets. In Sri Lanka, it is bank guarantees and LCs, right? So whenever you have indirect assets, you have to convert it to direct assets, risk-weighted assets. Before getting to risk-weighted story, all asset has to be in one line. You have direct assets, you have indirect assets, or contingent assets. Contingent assets need to be converted to direct assets or on balance sheet assets. In order to do that, we multiply by a factor called credit conversion factor. Credit conversion factor, CCF, right? So trading letter of credit, it is 100%. Standby letter of credit, it is 100%. Bank guarantees, it is 50%. Performance guarantees, it is 20%. Like that, we have 100, 50, and 20% different factors as per Basel, right? So you convert your asset into direct assets to get the asset book of your bank. You have your direct assets on balance sheet, then you have your off balance sheet asset, which is the contingent asset converted to on balance sheet. Then you get your entire asset book, right? Then capital divided by risk-weighted asset. Based on your risk factor, risk ratings, you can do a calculation. That's how the risk part comes in. What is the definition of capital? Capital is core capital plus supplementary capital. We have other words, tier 1, tier 2, and tier 3 capital minus deductions. These are tier different instruments comes under the capital, right? What are they? Core capital, tier 1 capital, paid up capital, that is our share capital, paid up share capital. Then non-cumulative preferred shares or preference shares. What is a preference share? Normal ordinary share is you can't guarantee any return. It can be very high or it can be very low or even zero. But when it is preference shares, you guarantee a return, right? Non-cumulative. On a preference share, if you don't pay this much this year, you have to accumulate it to the next year. But if it is non-cumulative preference shares, you can take it as tier 1 capital or core capital. Disclosed reserves or legal reserves or general reserve, what is it? It is the profitability reserves, right? It is the profitability reserve, the carried forward profit portion of the bank. So these are pure core capital. Then we have tier 2 capital, right? Again, that is also shareholders' funds, but not as hard as the first one, tier 2 capital. Then general loan loss provision, we can take it under here. Then any revaluation reserve, you can take it under here. Subordinated term debt. 5-year maturity, you take it under here. What do you mean by subordinated? Subordinated means we can delay payments. On a normal loan, you can't. You are compulsory required to pay. But when it is subordinated, all others will be paid before paying this one. 5-year debt. Then debentures, hybrid instruments, comes under tier 2 capital. Tier 1 capital, tier 2 capital. Then we have tier 3 capital. Again, subordinated short-term debt. That is to cover the market risk. When it is short-term, subordinated, 2 years. Right? So, capital is core capital plus supplementary capital plus tier 3 capital. Right? So, that is the capital. But we have to deduct goodwill. In our balance sheets, you can have seen goodwill. You have to deduct goodwill because it is not a value, hardcore money, goodwill. Then investment in unconsolidated financial subsidiaries, banking and financial subsidiaries, companies, and investment in the capital of other banks. If we have invested in the capital of another bank, you have to take out that part from our capital. This is to see what is the actual money of the shareholders of the company, right? If something goes wrong, if something goes wrong, you can't go to all these people, right? All these people you can't go and say, sorry, we made a mistake, no profit, I can't pay. No, you can't. Can you do it to fixed deposit holders? Can you do it to CASA holders? Can you do it to term loans, money market? No, you can't. But your own owners, you can tell that, right? All these people will have to bear it. Right? So it is capital equals tier 1 plus tier 2 plus tier 3 minus deductions. Right? Then we talk about losses. We have 3 types of losses. Right? We have this one. We have 3 types of losses. Exceptional losses. That means, can you remember the graph I showed you last time? Risk and uncertainty, tsunami. A loss occurred due to something like that, uncertainty. We don't bother about those things because we can't calculate and we don't know whether it will occur or not. Exceptional loss. Those are isolated incidents, so we don't take care of it. Right? So this part, stress loss or exceptional loss, is the tail end, which is a very small portion, and it won't occur very frequently. Then we have expected loss. That is the most frequent one. Right? It is the expected loss. That means when we do annual budgeting, we talk about revenue growth, we talk about portfolio growth. Similarly, we talk about NPL growth. When we talk about NPL, we talk about provisioning. Provisioning, we have 2 things. Firstly, general provisioning or time-based provisioning, specific provisioning. Now we look at impairment provisioning or impairment, which is collective and individual impairment, right? So expected loss is, we expect some sort of loss. In order to cover that loss, we say 3% NPL. I'm projecting a 100 billion growth. We projected 3% NPL. Therefore, we are projecting 1 billion provision. When we know that we are projecting 1 billion provision, what we do, in order to adjust that, we jack up our lending rates. We cut down our cost, right? We have taken care of this through the provisioning, right? We have projected provisioning. In order to accommodate this provisioning, you do other changes, right? Expected loss is tackled through provisioning, so it is also not a risk. Then what is risk? It is the unexpected loss, which goes beyond the expected loss. So we need capital to absorb this unexpected loss. If anything goes beyond our imagination, beyond our expected level, that is unexpected loss. For that, we use our capital. Then we can go to our capital holders and say, we made this loss because that we can't pay you dividends. We can't return your money for another year. You have to stay with us for a year. We can't pay dividends. That is this loss, right? This part. Okay. So losses are this: expected, unexpected, and exceptional. Expected loss is not a risk because adjusted through provisioning. Unexpected loss is managed through capital, right? We need capital in order to look at this one. So capital adequacy ratio plays a role there, right? I think during this course, you are learning this in detail later. So we have different types of capital, right? Economic capital or risk capital, an estimate of the level of capital that the firm requires to operate its business. Based on your portfolio risk level, we can calculate the capital, right? Then we say we need 100 million. Then regulator, CBSL says, no, you need to have 120 million capital. Then actually we have 95 million. Bank capital is the actual physical capital. Regulatory capital is the capital suggested by the regulator. As per the guidelines, the capital requirement is economic capital. Risk-weighted asset comes for this. Risk-based pricing, RAROC, or we say RORAC, RAROC, whatever. Risk-adjusted return on capital. Risk-adjusted return on capital. Risk-adjusted return divided by economic capital. I'll show you a calculation. Look at this. This is how we calculate RAROC, right? You have a loan of 1,000 rupees. Annual rate is 14. You lend this loan at 14, right? Then annually you'll earn 140 rupees, 1,000 into this. Then we assume our minimum capital adequacy ratio is 12%. out of 1,000, 12 rupees, 12% need to be our own capital. This is 120. This is our own funds. So I'm allocating this funds and holding it in our treasury bills. Invested at 8.4. So we earn a return on capital 10.09 rupees. So this is your earning from the loan. This is the capital requirement. We are not using our own capital for loan disbursement. We hold that required amount in treasury bills. So we have that money whenever required. Right? 8% treasury bill rate, this is an earlier example, I have not changed that. 8.4, so you are earning 10 rupees and 9 cents here. Right? So then you get deposits. You need 1,000 rupees here. You have 1,000 here. Interest on deposit, we take 10%. So our interest expense is 100 rupees. Expected loss, this is the probability of making a loss is 1%. So we say it is our expected loss cost is 10 rupees, 100 into, 1,000 into 1, it is 10 rupees. Operational cost is 20. Right? Operational cost is 20. ROC is equal to revenue minus expenses, return on capital minus expected loss. Right? Revenue is 140 plus, yes, 140. Expenses are interest expense minus operational expense. Then ROC, return on capital, return on economic capital 10.09 minus expected loss is 10. That is 20.09. Then the below is economic capital. Economic capital is this. Right? So 20.09 divided by 120 is 16.74%. By granting this loan, we have a risk-adjusted return on capital, which is 16.74%. This is a normal calculation we do for any customer when we are lending. Implied balance sheet is this. We have a loan of 1,000, government securities 120. So our asset book is 1,120. How we got this is deposit 1,000 and capital 120. So it is balancing. Assets and the liabilities are balanced. So RORAC calculation is this. Return risk adjusted return. So this is the economic capital. This is how we consider losses. This is the capital, and this is the capital adequacy ratio. Right? This is the question. So this is the risk-based pricing, right? So whenever we are pricing a customer, we work the ROC, right? And see whether we have adequate. You can hear me, right? Yeah. So always when we are pricing a customer, we look at the put all pricing and check the ROC. If it is above our minimum requirement, then we can have one facility at low cost, one facility at high cost. We do a risk-based pricing for the entire customer, because we can take
assets, we can take liabilities, everything can be included here. Right? So that comes to the end on that part. Any question from RARO calculation and those things?
Yeah, so the 12% that you took on this calculation, it's just the assumption, right?
12% is current
The
capital.
EC.
Yeah. Current
It's just
capital adequacy. Right.
okay. It's just a okay. Current. Okay.
Yeah, is the current one. Because we wanted to increase it to 14, but due to pandemic, we stopped at 12. It is the capital adequacy ratio whenever you are calculating. Right?
Okay. Right. Thanks.
Okay. Any other questions before I go to answer Asin sir? Asin. Right. Sorry if I pronounce your name wrongly. Right? Performance bond. We have different bonds, mainly on contracts, construction or even supply contracts. We have different bonds. We have bid bonds, we have advance payment bonds, we have performance bonds. Bid bond is whenever you are putting a bid tender, you have to give a small value, compensation value from a bank. If the bid is offered and not taken, bank should pay some money. Right? Then we have advance payment. Advance payment is to start any business, any construction, you need to take advance because you don't have enough money. You need to take advance. So bank has to guarantee saying that, okay, my customer will honor to the advance. So that is the advance payment. Then comes to performance bond. So there will be a performance standard. If it is a road, they say 100 kilometers, 15 meters width, thickness this, all those details they will take. So bank has to go and say, okay, my customer will perform the duties, perform the contract as per your requirement. That is called a performance bond. Even it can be supply of computers. My customer will supply as per your specification. If not, we will honor a claim. That is called performance bond. Is it clear? Right. Any other questions? If no questions, I go to the other part of the presentation today.
Sir, another small question
Yeah.
on the calculation. How did that RAR of numerator? How did you arrive at that amount? 20.09.
Yeah, it is like this. Revenue, which is 140, right? Minus expenses, but our
Okay.
interest expense and the operations.
Okay. The
Right?
yeah. All right. Thanks.
Okay. So we did this part. Now we go to credit organization. So credit organization differ from bank to bank, and based on our credit culture, it differs. The officer of a small bank may perform all the detailed work associating with making a loan. But in a larger bank, it is individual specializations. Right? I'll give you a small example. In large banks, we have credit marketing function people who go out and bring credit. Then you will do the documentation.
you send it to credit evaluation section, where they will do call verification 1%, report writing 1%, analysis 1%, like that. So it is different. In a small place, marketing by one person, evaluation done by the same person, financial analysis by the same person, documentation by the same person, even appraisal writing is by the same person. Right? So, based on the size of the bank and this specialization changes. Loan division, they perform the basic function of generating loans, business and supporting customers. You have music, right? It is everywhere in the country now. Right? Loan division, they perform the basic function of generating loans and support. That is the front end. It can be credit officer who is doing the marketing part, or it can be salesperson who is doing the marketing part. And we are the touch point for the customer. Then we have the credit department. We discussed this one, loan division, where is the customer touch point, and we do the marketing and main documentation part there. Then comes the credit department.
So we can't see the screen.
Okay, sorry. Can you see now? Is it visible? Okay,
Yes.
right. Right? So, credit department, there we have the evaluation. So, it is earlier loan, then we go to credit. Right? Loan making function is one, then evaluation function is, this can be even within the branch, or it can be even with a regional office. Branch does the marketing part, then regional office does the evaluation part. Or centrally at head office, you have a, like for our bank, we have central evaluation model, credit factory at one place. So all the loan documents will be routed to that. So evaluation and checking creditworthiness, everything happens there. Branch will do the loan generation part. Then for larger loans, we have relationship model where branch will generate the lead, and we have relationship manager sitting with the regional manager. They will do the evaluation. Primary mission of the credit department is to evaluate the credit worthiness and debt repayment capacity. That basically evaluation. Then train new officers, because you can't market a facility without having a knowledge on recoveries and credit. You just can't. It is like it is easy to canvas a personal loan, because you know, okay, you have a credit, you have a fixed salary, then out of that you can pay this much. But if it is a business loan, it is more detailed. You have to go in detail before canvassing, right? Then department may be responsible for loan reviews. Annually, we need to review the facilities that you have to do. Collection, sometimes, yes, they are responsible for the portfolio, so they have to follow up on the collection, but they are not doing actual collection. For that, we will have a collection department who is purely responsible for collection. But anyway, the entire responsibility lies with the loan division, because they are the ones who bring the loan. So collection, recovery, everything,
credit admin, everything is part and parcel of their job. It is not just I brought in, you gave the loan, I don't have to do anything. No, you are the one who initiated. So you need to assist the other departments to look at these loans, recover these loans. Then today's main lecture, CAU and CPU. CAU is credit admin, CPU is credit processing, central processing. Basically, it again depends on your bank size. One part, it is entire one function, but it is segregated. One team, they put everything to the system. Other team do all the wire transfers and disbursements and everything. CPU is the one who does the disbursement parts. CAU, if it is credit administration unit, they are the one who put everything to the system. So the main loan function is the perfection of bank's security interest in collateral offered in support of loan, right? Offer letters and bonds and everything. It is also perform the discounting function. So bill discounting, notes discounting, they will do. E-bill discounting, all those things. This is an example of a bank. I just got it from internet, right? See, you have a credit administration unit here, like that. So it is a different function. Let me go to this is the organization structure again. So we have to have an independent department that deals with independent department that deals with the credit function. There is, however, no organization model which is right for every bank. So depending on your bank size, your credit culture, your policies, we have to have different things. These are function of credit department. It is credit, central credit. All these establish in general credit policy, credit portfolio planning and control, set overall and specific credit limits, perform credit reviews, manage problematic exposures. All these things needs to be done by the centralized department. Whereas regional credit departments will look at portfolio planning, managing problem exposure. It is the job of all three. Delegated authority, normally it is here. Sometimes we give it to account managers level, but very few. Analyzing, yes, it can be regionally, centrally, or branch level. Credit structuring, also it can happen on the same levels. Then when it comes to credit documentation, it is mainly the responsibility lies here. Collateral administration, you visit, you look at the collateral, then valuation, everything will happen here, but these people are responsible for monitoring, right? So these are the functions of different departments at different levels. Then we talk about two things: credit concentration versus decentralization. Centralization depends whether you are going for pure centralization, as the Basel wants, whether we can go for pure centralization, right? It depends on few things. Developing a credit person takes lot of time, right? It is not easy like developing a marketing person or developing a pure operation guy. Credit is knowledge, experience, exposure, and common sense, right? As much as you are getting exposed to different type of people or different credit, you build your credit career. right? So good credit people are very scarce resource. That's why we want to shift to central department. So ability to have larger number of people, the product you sell. If you are going pure housing loans, personal loans, general products, it is easy to have a centralized operation. Again, if you are going for larger loans, specialized loans like power plants, coal plants, all those things, project finance type. Again, it is easy for centralizing because you need few specialized people. You can't have very large number of specialized people who can evaluate a power plant. Yeah, entire bank we may have 2-3 people, not more than that. So each branch can't have one. So we go for centralized. Right? Smaller leasing, we can give it to the branch. Like that, we can decide based on the product and the specialization requirement, whether it is centralized or decentralized. The profile of the bank credit portfolio has an important bearing on the credit department. We say we have larger number of bigger loans. Then centralized function is the best because you have to monitor it very well. But if you have large number of smaller loans, you can have a decentralized one. Then size of the bank and geographic dispersion. Like if you are a big bank and spread it everywhere, you can have a decentralized because center will provide you the detail, cover, but regionally, like it is not applicable to Sri Lanka. But look at HSBC. Centrally, they will give you the credit policies, but each region operate autonomously. Like our Sri Lanka is operated through Indian regional office, right? Like that differently. Currently, I don't know. I think it is Indian regional office. So based on that, they will have within the guideline, they will have their autonomy to operate. Credit culture and the tradition of the bank affect the way credit function regulate. Right? Sometimes when the credit culture is strict, value driven, so everything tend to centralize with more controls. Right? Advantages and disadvantages of centralized department. Economies of scale. You can have larger loans output with very few people. I need credit people. If it is a decentralized one, I need each branch very good credit officers. If I have 10 credit officers at the center, they can process all the loans. Concentration of expert, fewer personnel requirement. Compliance with credit policy is easier to control. Why? Credit policy is given centrally. So when the large number of people are operating on the credit department, they tend to interpret as their knowledge. But if it is a central place, few people very strictly monitored. If some message want to send, it is here centrally, few people. But if it is 1,000 branches, it has to go to everyone. Sometimes it may take the delay. Right? Disadvantages, local credit people, branch, it is central, not me, I don't know. Things can happen. Like the big guy in Matara is now on to the central person. But if it is, like we say, Matara, Manamperi is one of the biggest guys, right? The service the branch will give to Manamperi and the service the center will give to Manamperi is different, because for Matara branch, he is the best. So we need to protect him. We need to keep him. We need to deliver everything. But for center, he is another customer only. Local market conditions, they centrally, they will look at everything on the same platter. But local market situation, who is the best customer, who has the influence in the market, those things does not matter to the central people. More bureaucracy. This is our laid down process. Can't do anything. Very recently it happened, right? Wanted a personal loan, approved, but with a 150% standing instruction. Right? So it is, that is our policy. So if it is centralized, it is the policy. Yes, agree. But if it is the branch level, or branch level knows it properly, they should communicate. So customer get dissatisfied because of that. It can happen. Right? Poor communication. Longer processing time. Sometimes when it is there is a delay, so everyone comes to one place, there can be a bottleneck. On the other hand, decentralized, we have advantages and disadvantages as well. Advantages are local autonomy and responsibility. It is the branch or the regional office who approved it. So they are fully responsible. Then entrepreneurial initiatives. So you have to face the competition, you have to make the customers. Whenever you come to a center from a branch, you save at least 5-6 years of your life. The pressure you get at the branch and the pressure you have at the center is completely different. Right? Even I didn't realize until I come to head office. Reduce processing time. Branch, you can't sit on anything because customer comes and sit in front of you. For center, you just say something to the branch and wait. Who cares? But branch, you can't. You are facing the customer. Customer pressure is the most difficult pressure. Closer to the customer and local markets. So, you know the customer knows you, local market conditions, you know, that bank is approved within 1 day, 2 days, so I also have to do the same thing. Let's report into head office because it is within the branch, so we get it done. Within the region, we get it done. You don't need to report to head office everything. Less bureaucracy. Right? Regional manager is there to go speak and get it done, than writing emails and getting everything done through systems. Then disadvantages, sophisticated control and risk monitoring system required because we have given the powers to decentralized units. So everything needs to be properly monitored from a center. More credit people required. Center you need 10, but if it is given to regional, again, number of regions, you need so much credit people. If it is given to branches, so much credit. Less consistency, the evaluation from one person to one will be different. Greater risk of insufficient controls. There can be control lapses at any time. That is happening. Then you have documentation requirements.
These are the details required under different sections of a credit file. Detail about the counterparty or the borrower, amount of credit, purpose of credit, repayment purpose, sources, collateral. Typical credit file contains at least these files. Then when it goes to financial analysis, you need to have all these requirements. Then valuation details, you should have one section up to approval, then you have disbursement, then you have legal case documentation, valuation plans and legal documents. So status of collateral, valuation report, security, and all those things you need. So these are the main 4 items, sections in a credit file, credit documentation. Right? So that's come to the end what I prepared for today. If you have any questions, I'm happy to answer. Account manager, here it says the branch level. It can differ. Like even corporate, you can have an account manager. Then relationship managers can sit on head office, or they can sit on like in my bank, we have relationship managers, business banking sitting on regional office. Right? Normally account manager, that can be termed anything. Right? Any questions?
Sir, this is Dushantan. There is one more question.
Yes, Dushantan.
Yeah, when the credit authority, when we are decentralizing,
Yeah.
there is a possibility for the malpractices and biased decision.
Yes.
But on the other hand, there is an advantage, as you said, that quick service and we can get the business. So how we can control and how we can balance?
It is a multi-dollar question, right?
Yeah.
Right. Chamatka, just wait, I will answer. Normally what happens when we, when we decentralize, all those what you said occurs.
Yeah.
Right? So you should have internal audit continuously. You should have spot audits, regular things. Then CAU function.
Yeah.
Also, you have to be strengthened. Reporting functions need to be strengthened. Right? So, like centrally, you can have reviews. Like LRM, loan review mechanism.
Yeah.
So, you can have continuous, more frequent LRMs than normal one.
Yeah.
That way, you have to have controls. Otherwise, it will go for 6.
Failure, right?
Yeah.
Right.
That's why the BCBF is advocating centralized operation than decentralized. Right?
Right, sir. Okay, thanks.
Right. Yes, it is. There is a very small difference. RORAC and RAROC, it is also the same. Right, Chamatka?
So how can we calculate the risk for a potential customer?
It is, you want to say the RORAC for potential customer?
Yeah.
It is a projection only. See,
assumption basis.
Yeah, it is assumption basis. What we do, we say we are giving 100 million facility. Right?
Yes.
Then we will calculate what is the income on the loan. Then
we say, okay, if we operate the current account with a credit balance of 5 million, what will be the income we generate? You have a cash build-up. What will be the income we generate? Like that, we get all the projected, right? If it is LC involved, we take the LC commission. Like that, we take everything in the revenue line.
Okay, sir, got it, got it.
Right. Anyone else? If no questions, everything good to go. And next week we will have we will discuss CAPM model, capital pricing model, and yield curves. Right? Okay then. Thank you.